Thank you very much for joining us today. We hope that after watching this presentation, you've seen how we delivered a strong set of results in 2025 and how we are firmly on track to deliver the targets that we set ourselves at Capital Markets Day 2025. And now Sinead and I will be answering your questions. So please, could we just have 1 or 2 questions each so that everyone has the opportunity? With that, could we have the first question, please, Jake?
Our first caller is Alistair Sim from Citi.
Thanks. Hi, Wael and Sinead. I feel obliged to kick us off on reserves. You've listed a huge amount of portfolio refocus in the upstream, but I guess for Shell we've had 3 years of sprint and cost takeout, but at the same time reserve life has fallen 15%. And if I take you back a couple of years ago, you used to say there was no portfolio problem, and I think now the message has morphed into one that sort of acknowledges there is a bit of a problem to address, but there's no hurry. So I guess the question is, what is the plan? How do we frame the timeline around hurry? And how can you counter the market concerns that the business is simply shrinking? Thank you.
Yeah, thank you very much, Alistair. I'll suggest I kick off and then maybe Sinead bring you in. First, thank you for the question. I think I'll start with what you and I have talked about in the past. Where we start and what I keep saying and I keep hearing back from my investors is that at the end of the day, it's intrinsic value creation that we are driving. And it's particularly value creation per share that we are driving towards. And so there are a few elements of how we are unlocking that. I think you touched on one of them, fundamentally driving the performance culture in the company, the takeout of the $5 billion of cost reduction, and we are now driving towards the higher end of the $5 to $7 billion range. There's more to be done on capital efficiency. There's more to be done on improving the returns on the actual capital employed. So there's significant value uplift on that side of it. We also showed, of course, in Capital Markets Day 2025, the trajectory to 2040 for both integrated gas and marketing, where we see our cash flow growing from around 20 billion last year to close to 25 plus billion at a slightly lower capital diet. So all of that is showing the growth. But then let me come specifically to the heart of the question around resource. What we have tried to do is look at the resource as an important KPI in the overall mix, but most importantly, look at the cash flow that's coming from it. I mentioned in Capital Markets Day that we had a gap to 2030 that was close to 100,000 barrels per day to be able to, for example, keep our liquids flat. I'm pleased to say that with the $2 billion of deep water bolt-ons that we did in 2025 and improved recovery from some of the reservoirs we already have largely plugged that gap of the 100,000 barrels per day. So that actually gives us the runway to be able to de-risk the 10% free cash flow per share that we talked about in Capital Markets Day. Your question, though, is a fair one when you look at the 2035. We still have a resource gap there that we plan to fill. But we want to make sure that the bar continues to be high there. And we have a few years to be able to fill that gap. So this is not ignoring the issue, but this is de-risking what we can see in front of us, what we can control, and making sure that we deliver on our commitment to our shareholders to do it in a highly accretive way. And that's what we want to be able to work on. We are liquidating the 1 million barrels per day of new capacity we're bringing in. Last year we brought a quarter of that. We have another 750,000 barrels per day to bring online. We have exciting new projects like Bonga Southwest that is also coming in the post-2030 timeframe. We need to be able to move those things through, but the core continues to be one of real focus on proper capital stewardship as we unlock that future cash flow. Sinead, maybe you want to add a few words?
Yeah, just a little bit on that as well, because I think you covered indeed how we're closing the gap. Let me just talk you through our thinking a bit. I think as Wael positioned very well, of course, things like reserves or R over P are important metrics, but it's only one metric as we look at the depth of our portfolio. So let me go specifically on R over P. So roughly speaking, we were at about 7.8 years, as you know, now, which came down from 9. How did we, and what were the decision making between coming down from 9? two main elements of that. One was the SPDC sale, so the sale in Nigeria of assets, and the other, of course, was the move with respect to oil sands, both of which we've talked over the last year or so with you. And of course, both were very conscious decisions. And of course, the reason they were conscious decisions, if we'd kept them, we would have stayed at about the same level, given all of the additions that we had as well. But we consciously chose not to do that. And that 2 billion of capex instead that we moved towards deep water, what did that do? The fact that we put it into deep water, and that was Gulf of America, that was Brazil, that was Nigeria as well, and a number of other aspects, those ended up with very high margin barrels, but of course didn't have quite the same length in terms of the R over P or the impact on the R over P. We chose to go with high margin, therefore creating value, rather than just trying to manage to a metric. And of course, as you know, when we talk to the shareholders, it's very much about focus on not moving towards one metric, but actually generating value.
And so let me close then, Alistair, and thank you for that, Sinead. What I will say is we are, of course, at an inflection point as a company as well. We have really been focused on the performance drive, the embedding the performance culture, and I think made great progress. What I can say and what I will be saying to our investors is both Sinead and I will bring that same focus and rigor now as we have really gotten the self-sustaining performance loop into the company. We will now look at portfolio reallocation, how we are going to be reallocating capital to the opportunities that allow us to unlock even further growth post-2030. And that's where our attention will continue to go in the coming years. Thank you for that question. Jake, let's have the next question, please.
Our next caller is Josh Stone from UBS.
Yeah, thanks, and good afternoon. Just a question on the buybacks. I'm curious as when you set the buyback, how much of a close call that was this quarter, because I understand you've got a strong balance sheet, prices seem to be holding up better than expected, but also for the first time in a while, we've got more people buying energy stocks, and your shares have clearly re-rated with that, and they're more expensive. So was that considered at all in your decision to leave it flat? And how close was that call? Thanks.
Thanks for the question, Josh. Sinead?
Yeah, no, happy to take that. Thanks, Josh. Really good question. And what I like is you're asking us about how we think about it. And it is a conscious decision in terms of capital allocation each quarter, of course. I mean, with respect to the buybacks and where do we go in the buyback, I mean, one of the first things I would say is what we've looked at is the fact that we've bought back roughly, 25% of our shares, I think, over the last 3 years. And of course, that's at some 20% below where our share price is today. So you can see the allocation around that. So that thoughtfulness is there. The frame that we use has been sort of quite clear. We've always said to you that sort of 40 to 50% in terms of CFFO distribution is sacrosanct. And of course, that varies a little bit quarter to quarter because it is through the cycle. So you see that in our thinking. And of course, this quarter it was 52%. But you have volatility with price and everything else coming through. So we're very comfortable and very focused on staying within that. But indeed, we still see the buybacks as, particularly at this sort of price, as very much value-led. And of course, we have such a strong balance sheet, as you know, when we're sitting at some 20% of gearing as well.
Thank you for that, Josh. Next question, please, Jake.
Our next caller is Irene Himona from Bernstein.
Thank you very much. Good afternoon. I had two, please. So first, can you please speak around the key financial impacts of the Adura joint venture in the UK in 2026 on key metrics like perhaps your cash dividend receipts or upstream tax rates, etc. And then secondly, looking at group return on capital, obviously it is below double digits. It's clearly not helped by widening chemicals losses. The chemicals down cycle appears to be a really prolonged one, which is clearly something that cannot be controlled. So I wanted to talk around what you are controlling in chemicals, and in particular to ask about progress on the announcement you made at CMD 25 of the restructuring intention for chemicals. So how far has that progressed? Thank you.
Thank you very much, Irina. I'll take the second one. Maybe you want to start with the first one on Adura?
Certainly. Indeed, Adura, really pleased, Irina, to see that actually up and running with our partner on the 1st of December. Teams are doing well there. It's really is a standalone venture, of course. You can see them out there looking at raising debt to be able to continue to grow that business and to be able to use capital very efficiently there as well. But you specifically asked about how would we see that play out in some of our metrics. What you see, of course, is because it is a standalone entity, you see a lot of the normal aspects pulling out. You see the production reduced coming through in our outlook, or that production being reduced in our Q1 outlook as well. So you see that in the upstream numbers. And in contrast, what you will see, as you exactly rightly say, we'll see dividends coming in. Now, we don't tend to give guidance. Of course, it's a standalone venture, as you know, but we expect to see considerable dividends coming through. And of course, I saw yesterday, of course, our partner, of course, made some comments in that respect as well. Venture is strong. It has the ability to grow. It's the largest, standalone producer, independent in the North Sea now, and they're looking at many more opportunities, and they're driving hard to be able to return to the shareholders the dividends that they've rightly promised us.
Thanks, Sinead. Irena, to your second question around Group ROACE and then the chems. So a couple points maybe. Firstly, in my response to Alistair's question, I talked about our real focus on performance, right? We want this company to be the best performing, best returning company in our sector, positioned for longevity and positioned for sustained growth. And so we've been focusing very much on the performance, and actually that's also starting to show through on the returns. You saw that this past year at 9.4% ROACE. By the way, that was up compared to 2024, despite a $10 drop in oil price. And that shows you we're making progress. Some of that progress is coming through, for example, in mobility, where we had put a target of getting to 15% ROACE. We're up from 12% to 15% in 2025. Lubricants is up from 19 to 21%. Res, despite the fact that it is still nowhere close to where we need it to be, is up 4 percentage points on ROACE as well between 24 and 25. So we're making progress. And chemicals is not where it needs to be. And there's a couple of elements around chemicals that you touched on. Let's talk about firstly the strategic element of chemicals. Nothing's changed from what we talked about in Capital Markets Day. What I also said in Capital Markets Day is we are going to be patient, because while we know where we want to go with it, we do not want to be selling at bottom of cycle conditions. We have promised our shareholders to be good stewards of their capital, and what we are looking at the moment is constructs that could potentially work. I won't update you at this stage on where things are, because there's nothing specific to update on, but you can rest assured that we continue to look at opportunities around that. Where I would say I have less patience is in our own self-help. I already indicated a couple of quarters ago that we are looking at what more we can do, so the team did some great work around that. Q4 was a bit more difficult as well, because we had a planned downturn in Monaca. But as we come out of that, we hopefully get a bit more tailwind there. But most importantly, we have identified a few $100 million worth of cost reductions, CapEx reductions, to be able to just ensure that we get closer and closer towards free cash flow neutrality, so at least it covers its face in a difficult macro like we have at the moment. Hopefully that also sets us up for a better performance when we see chemical margins come through. But we are assuming that if there is a prolonged period of depressed chemicals margins, that we at least need to be able to avoid the bleeding in free cash flow from chemicals. And that's very much our intent and what we're focused on. Thank you for the question, Irena. And Jake, if we can take the next question, please.
Our next caller is Biraj Borkhataria from RBC.
Hi, Wael and Sinead. Thanks for taking my questions. My first one is just on operating costs. You've clearly made that a priority in recent years, and there's progress being made. When I look at your divisional breakdown, the one thing that surprises me is that when I look at the renewables business, the OpEx still looks outsized relative to the size of that business and the contribution and I guess the outlooks. So my question on that front is, why aren't you moving faster to reduce costs specifically there, or is that building options for the future, or is something else? And then just a second question, a follow-up to the resource one. In the past and even today, you've mentioned you want to be counter-cyclical. So I guess there's a balance between knowing where you are in the cycle, but also understanding the competitive landscape. As I'm listening to your peers talk about the same issue over recent months, a number of them have started to talk up M&A. So you could argue there's increased competition on the buyer side. So just some perspectives on your patience and the competitive landscape would be helpful there. Thank you.
Biraj, thank you for those questions. Let me take the second one and maybe give you the first one, Sinead. Look, I think you heard me, Biraj, in the third quarter results, open up the space much more for M&A as we start to get much more comfortable that we now have the internal performance to be able to unlock value better than others can. And that to me was an important element of what we needed to do, because I didn't want to simply add resource for the sake of it. Of course, we had started with a capital budget of 25 to 27 billion. We took it down to 22 to 25 in CMD 23. We took it down to 20 to 22 in CMD 25, and we haven't used the full capacity. Not because we can't buy barrels, but because we have said to ourselves that we're only going to go after accretive barrels. That's what's core for us. Now, as we look at the landscape, I'd start off by saying the biggest thing we had to do was to continue to create the space for us to have the strategic patience. And to Alistair's question, we now have that line of sight to 2030, which means we've built ourselves a few years to be able to really be selective about what we go for. But we are hungry for growth, don't get me wrong. But we want to do it on the right terms. And so where do we see opportunities to play? Where we can synergize, not simply buying the barrels, but where we think we can bring particular technologies, where we have synergies with existing assets. You've seen us do deals in Brazil, in Nigeria, in the Goa. Those are the sorts of areas where we can play in, but there are other areas where we are looking for that. We will continue. I can tell you, I have a lot of opportunities coming to my desk on a regular basis. And I would say I see more of them starting to screen now than we would have a year ago. But we are looking at making sure that we do not fall into the pitfalls of the past, where we start to sort of do deals for the sake of resource buildup, rather than do deals that create value through the life cycle and allow our shareholders to be able to really get the most out of the decisions we're taking. Sinead.
Indeed, and thanks, Biraj. You're absolutely right in terms of cost being a focus over the last period, but it's been cost really in service of performance. So what have we done? As you know, we've taken some 5.1 billion out of structural costs over the period, so actually heading into the bandwidth which we had talked, or the band that we talked about as a target for Capital Markets Day 25, so we've done it a couple of years early. So you can really see the business motoring in terms of just, as a company, how can we ensure that every dollar is allocated in the right way? And there's a lot more to come, that's clear, and there's a lot of pressure from the boss on making sure we do actually deliver on that as well. But specifically, it's very thoughtful about where we take it out. And as you say, in terms of our renewables segment, there is more to come. But we've actually taken $1 billion out of OPEX over the last few years there. And we're changing the portfolio mix, remember. So as we change that away from some of the generation assets that we would have had before, we're moving it more towards some of the flex and assets that we can trade around. So of course, what you're seeing is, as we make some of the divestments, as we change that portfolio mix, that comes down on that side, but it actually goes up in terms of the actual flex side. And actually, we had quite a bit of OPEX that came from our CCGT acquisition in Rhode Island as well. So that's coming through. And remember, that RES portfolio, or that renewables portfolio, is continuing to change. And actually, we've done more than 15 deals over the last 2 years in that space, more than half of them actually within the last year as well. So more to come.
Thanks, Sinead, and thank you for the question, Biraj. Jake, can we take the next question, please?
Our next caller is Paul Cheng from Scotiabank.
Hi, good morning or good afternoon. Can you talk about the new opportunity set? Seems like with the open up of Iraq, Libya, and Venezuela, and how attractive are those to you guys? And whether you are concerned the open up of these countries will compound the oil market oversupply, and if that is the case, how will it shape your capital allocation outlook, if any? Thank you.
Thanks for the question, Paul. Look, I'd start maybe first from a longer term perspective. So we continue to see growth in energy demand through to 2050 at the moment. So some 25% uptick between 2025 and 2050 in terms of overall energy demand. We see oil demand continue to grow roughly by that 1 million barrel per day tick, at least for the coming few years. And remember, we're losing around 5% of overall supply due to depletion. So every single year, you're having to refill 6 million barrels per day. So longer term, the fundamentals continue to be very constructive, I would say, on oil. In the shorter term, you're right to sort of hint to the fundamentals being maybe slightly long in terms of supply, but that's being balanced by a lot of geopolitical risk at the moment, whether it is Venezuela, whether it is Iran or others. You're seeing more ships at sea, and that's creating, I think, a bit more balance and helping the oil price achieve what it has achieved. Now, turning to the specific markets that you've talked about, there is of course potential to unlock more production, but the world will need that production. So it doesn't concern me. It actually encourages me that we will be able to find the supply to be able to meet that demand. Most importantly, I think we are very well positioned to be able to play in some of these theaters. I was in Kuwait just a couple of days ago where the KPC announced the opening of some opportunities there, which we will be looking with interest in. We are in discussions, of course, with the Libyans. We have an MOU for some fields there. In Venezuela, we are well positioned, in particular in the gas side, given some of the work that we had been doing even before recent events, and so on and so forth. Iraq, again, we have a strong position there. So we see ourselves as particularly well placed to be able to enter some of these theaters. But again, it's going to depend on the entire sort of risk-adjusted return profile and our ability to be able to say to ourselves, is this where we want to deploy our capital? It doesn't change our appetite in terms of the longer-term fundamentals around oil. We continue to be bullish and constructive on that. Thank you, Paul. Jake, let's have the next question, please.
Our next caller is Michele Della Vigna from Goldman Sachs.
Thank you very much for taking my question. I wanted to ask you about LNG. It looks like we're going into a period of oversupply where we may need the shutdown of some US LNG plants, at least for a few weeks in the summer. I was just wondering, how should we think about that potential outcome into the Shell portfolio, with the positive being probably on the trading side, some of the negative in terms of some of the spot gas exposure? And also, in a cheap LNG environment, we should see rising LNG demand, but one of the big areas of growth, which has been China, feels like it may be slowing down, and potentially with the geopolitical risk rising, they may not want to depend so much on a commodity where the US is the largest producer in the world. So just wanted to have, if possible, some of your thoughts on that. Thank you very much.
Thank you, Michele, and let me maybe touch on that. So what do we see in the LNG markets at the moment? Again, if I take the long-term perspective, if anything, we are seeing even more constructive demand for LNG. We see it more and more playing the role of the stabilizing force in most energy systems. I mean, take Europe, for example. We do not have, of course, the coal assets of past. Nuclear will take a long, long time to be able to bring in. As Europe shifts its energy system towards more intermittent renewable energy, you will need more and more of that stabilizing force, which of course LNG plays. And that's demonstrated just this year by the fact that we have had record imports of LNG into Europe. You consider now where we are also in the current cycle, even if you think prompt and midterm. Just at the moment, we're looking at storage levels in Europe at the low 40% compared to the 5-year average that is closer to 65%. So Europe will continue to play a big role. We see both China and India actually also still constructive on LNG, but at a certain price point, which is closer to the $8 to $10 rather than above 10. So I don't think the Chinese or the Indians are averse to taking more LNG, but they want it at the right price point compared to the alternatives they have, which typically is domestic coal. So where does that leave us as a portfolio? I think we are incredibly privileged to have such a diverse set of supply opportunities. One of the best, of course, being LNG Canada with AECO indexation that allows us to supply our markets, in particular in the East. We, of course, also have significant access to US LNG. I don't know whether there will be shutdowns or not in the summer, depending on demand levels and the wave of supply and how quickly it comes. But I would say we are very well positioned, given that balance of diversified supply, diversified demand. We have multiple different indexations to whether it's Brent, TTF, we can sell on Henry Hub or AECO, and so on and so forth. So the cross-commodity exposure gives us opportunities to be able to create value. out of the volatility that comes with that LNG market. So do I expect a length in the LNG market? Who knows? There might be some, but we look through these cycles and create value over the long term for our shareholders. Thank you for that, Michele. Jake, let's go to the next question, please.
Our next caller is Kim Fustier from HSBC.
Hi, good afternoon. Thanks for taking my question. I wanted to go back to chemicals. Last quarter, you talked about cutting several $100 million from chemicals. I think you referenced that again today. But I mean, this could be a very extended down cycle of up to another 4 to 5 years. So a few $100 million of cost reductions may not be enough. And presumably somebody has to shut capacity. So what exactly would be stopping you from outright shutting capacity? Is it the benefit of integration with your refining plants? Is it the environmental cleanup costs or labor issues in Europe? And then I wanted to go back also to the upstream longevity point. You've talked about that, and yet we're seeing Shell continuing to put assets up for sale on the market, such as Vaca Muerta in Argentina. I would have thought Vaca Muerta has a lot of running room, and you do have plenty of unconventional experience. So if you could help us understand the logic of that particular asset being put up for sale, that would be great. Thank you.
Thank you. I will let maybe Sinead start with that second question and correct that fake news article that came out, and then I can address the chemicals one.
I think you just did it perfectly. Kim, I've seen the same article. I don't believe we've said anything about that specific asset at this moment in time. So indeed, lots of things I read in the paper on many other assets apparently that we're selling as well that I wasn't aware of.
Thank you, Sinead. And Kim, to your chemicals point, shame on me, I should have also mentioned that. Of course, we are also looking at unit by unit shutdowns where required. At the end of the day, we're looking at cash costs of each of these units and making the choices depending on where we are in the cycle. But nothing is off the table. Let me put it that way. We are looking at all the opportunities to be able to really get to free cash flow neutrality at some of these more severe realities around margin. And we are leaving no stone unturned. Thank you for those questions, Kim. Jake, let's go to the next question, please.
Our next caller is Martijn Rats from Morgan Stanley.
Hi, hello. I've got two questions, if I may. I wanted to ask about trading. Sort of full year results always sort of a good one. I know throughout the year can be a bit volatile, but looking back, 2025 group return on capital was 9.4%. But often you're willing to provide a comment about that the uplift of the trading created to the group ROACE 200 basis points, 400 basis points. Usually they live in sort of that sort of ranges. In 2025. Broadly speaking, were we at the upper end of that range, lower end of the range? What was roughly the contribution of trading? And then the other one I wanted to ask, maybe a small point, but it relates to Kazakhstan. There seem to be some punchy compensation claims coming from the government of Kazakhstan. Now, it's not that we've seen these, we've seen these before, but I was hoping you could share some perspective on that situation.
Thank you, Martijn. Did you want to take the TNS one first?
Yeah, happy to, Martijn. Thank you for that. Indeed, as you know, our trading organisation continues to be a core part of Shell's proposition. We have great individuals in there. We have a great set of assets that they get to trade around and some judgments that have to come with that as well. So indeed, we've talked before about the uplift that they provide in terms of being able to optimise across the organisation or across the portfolio for us. They've continued to, over 2025, as you say, had a very good year as well. Of course, Q4 is typically softer for us in terms of trading, particularly in terms of our crude and products desks, so just about there. And we've talked about that a number of times, and you see that play out in CMP as well. And that continues to be the case this year. They have done more towards the lower end of that range in terms of, you said, 2 to 4% in terms of ROACE, but really pleased with what they deliver, and they're continuing to deliver this quarter as well. So thank you.
Thanks, Sinead. Martijn, on Kazakhstan, it would be inappropriate, of course, of me to sort of get into details around that, given there's some legal proceedings happening at the moment. I think suffice it to say that we are disappointed that we can't see alignment between the joint venture partners and the government on some of these topics. It does impact our appetite to invest further in Kazakhstan. So we watch the situation with care. We think that there's still a lot of potential investment opportunities in Kazakhstan, but we will hold until we have better line of sight to where things end up. And I leave it to the individual joint venture sort of projects to be able to make sure that they represent the position of the joint venture partners in a unified way. But let me leave it at that point for now. Thank you for the question. Jake, let's go to the next question, please.
Our next caller is Lydia Rainforth from Barclays.
Thanks, and good afternoon to you both. A slightly different topic, agentic AI. I think you signed up with SLB to deploy agentic AI across the upstream. So I'm just wondering, what does that look like in practice, and what are you trying to get out of that? And possibly linked to that, so obviously you've already achieved $5 billion in structural cost savings. Target is 5 to 7 by 2028. So why not lift that? And then secondly, you took the idea that there's more to come. The free cash flow growth per share target or ambition of more than 10% out to 2025 or out to 2030. 2025 was sub 5%. So was that a disappointing number to you, or was it just as you expected? And basically, it does imply that there needs to be an acceleration of free cash flow growth. So when do you actually see that? Is that 26 or is it more 28 to 30? Thanks.
Thank you for that, Lydia. Did you want to take that second question? I can touch on agentic AI and how we're deploying it.
Certainly, indeed. So as you say, we had, so in terms of the free cash flow per share, it is a target, as you say, out to 2030. We also knew that it was going to be variable across the different years as well, Lydia. So you see that year to year as it comes through. And of course, in this upfront period, of course, the share buybacks are a key part of that as well as we go through. So in terms of were we disappointed in terms of where it was for 2025? No. We knew where it was expected to come. And we've, of course, got a wave of different projects that are coming through. We've still got LNG Canada, of course, that is still to ramp up to its full capacity. And we've talked about as well the number of different projects that seem to go. It is not linear. We know that portfolio will change over time. And of course, as Wael's already alluded to, there's a lot more to come in terms of performance. So that drive on performance is certainly not over, and you will see that play out as we continue throughout the rest of the decade as well.
Yeah, and to your question then, Lydia, on to the broader bucket around the cost reduction. So I think, as you rightly said, we signposted the $5 to $7 billion. Really pleased with the momentum the team continues to drive, getting us to the lower end of that already. My expectation of the team is we do hit the higher end of that come 2028, so we will be driving towards it. And AI is one of those key elements. Agentic AI is one of those elements. Now, where are we on that journey? I'd start off by saying that the investment we have been making in data cleanup over the past few years, the investment we are making to be able to harmonize ERP systems, for example, in trading and supply, we are looking to modernize our ERTMs, to standardize them, and to make sure that they bring the data-centric architecture that allows us to scale up AI's benefit across the organization. So this is playing out not just in upstream, it's playing out all across. In upstream specifically, it's playing very much into the subsurface space and how we high grade our interpretation of subsurface, both for existing reservoirs, but also as we look into exploration. And it's playing up in areas like proactive technical monitoring and the maintenance that we do. I would say agentic AI is also playing up very much in our functional journey. So as we look to continue to not just apply automation into the way we work, we are challenging the way our workflows are constructed, because agentic AI means that we can fundamentally approach those work outputs in a different way. So I find it an exciting journey for us. We are not yet banking all sorts of cost reductions coming out of agentic AI because, to be honest, we're still learning. There is a lot of hype around it at the moment, and we're trying to focus on where can we actually deliver real cash gains rather than talk about it. And so I will withhold judgment as to how much it will impact the bottom line until I can give you an honest reflection on the impact it can have. Thank you for that, Lydia. Let's go to Jake.
Our next caller is Lucas Herrmann from BNP Paribas.
Yeah, thanks very much for the opportunity. And Wael, Sinead, good afternoon. couple, if I might, just going back to Alistair's opening question. When you think about resource and you think about resolving, the resource issues, for want of a better word, do you think we're really thinking about resolving for a deep water issue in that, that's your greatest strength, should we say, or one of your greatest strengths, certainly in terms of the upstream, and obviously the margins there and the return on capital there has the potential to be, very attractive. So question one is really just back on Alistair's, what are we trying to resolve for? And question two, far easier. When I think about this year and LNG, it's really about volumes and about growth and opportunity. I mean, it looks as though you've got incremental gold volume coming from Calcasieu, from I don't know how free things are around Pavilion, volume coming in for Plaquemines, volume coming in from Canada, obviously. So it feels as though we're at a point now where LNG, in volume terms at least, should really start to drive improvement. And perhaps you can add to that by just commenting on where Nigeria Train 7 is and what your thoughts on timing are there. Thanks very much.
Thank you, Lucas. I'll ask Sinead to take the second question in a moment. Let me just address the first one. When we think about the resource base that we want to sort of add to the funnel, I'll tell you we're agnostic, Lucas. I mean, we start from a position of we have a differentiated strength in deep water. And of course, we can play into that strength. But we also have some real strengths in a bunch of basins with a bunch of technologies in our conventional oil and gas portfolio. And we have continued to hone our strengths in areas like shales. I mean, look at what we're doing in Grand Birch, look at what we're doing in the Vaca Muerta, look at what we're doing with QGC, the upstream part of our Queensland assets. And so we are looking at how we can actually complement some of those strengths and create value out of it, rather than trying to be too narrow. At the end of the day, this is back to what I talked about earlier, creating value per share and finding ways to be able to actually deploy our capital in something that's going to be accretive. And so let's call it our North Star, rather than necessarily what's particular resource and in what country. Sinead?
Thanks, Lucas. Indeed, you're asking about what is our expectation in terms of some of the LNG volumes coming through. I think two ways to take it. Of course, you're right. We have volumes that are coming up, whether that's indeed LNG Canada actually delivering in terms of now up and ramped up and getting to its full potential. We've got some number of third-party volumes, as you mentioned, coming through. And then, of course, we'll have different items such as Qatar in the years to come. But it's more about what do we do with those. At the moment, we have quite a balanced portfolio. We don't have a lot of additional length, and we talked about that before. We're a little bit tighter, and therefore we haven't had as many opportunities to be able to deploy some of that trading capability that we have had in the past in different positions around the world. Some of those volumes will continue to come in the time period. But also, if you look at it, we talked about actually having a growth in terms of our LNG sales of 4 to 5% coming through over the next period per annum, actually through to 2030. Actually, what we saw in this last year was our sales grew by 11%. So you can see that sales side of things absolutely there and continuing to grow, and we need the volumes to be able to match that. So, of course, yes, some of those volumes will start coming through as well.
Thanks, Sinead, and thank you, Lucas. Jake, can we take the next question, please?
Our next caller is Doug Leggett from Wolfe Research.
Good morning, everybody. Thank you. Good afternoon. Thanks for taking my questions. Wael, I know this reserve number, you've kind of inherited that. It's been flogged to death today, but I want to ask you a direct question. As you inherited the portfolio several years ago now, do you believe legacy Shell has underinvested? And if so, how do you fix it in short order, whether through M&A or without a step up in CapEx? That's my first question. And my second one is probably for Sinead. And it's just going back to the recommitment to the buyback. Going back to your strategy day, you had assumed a flat real oil price. Can you maintain that 10% free cash flow growth per share without the help of a flat real oil price or without leverage? Thanks.
Good. Let me take the first one then, Doug. Look, I mean, I don't often look back, and if I were to look back, I would say I wish we hadn't walked away from Guyana when we did. That's the honest truth. How do we resolve the issue going forward? Look, at the end of the day, I think we play to our strengths. I mean, today we can underwrite a production flatline on liquids, and we have said we're growing our gas by 2% between now and 2030. And what we are finding is, as we really focus on understanding of our reservoirs, really focus on making sure that we are going after every drop, that is really unlocking value. I mean, remember, these reservoirs, we're barely scratching the surface of 25 to 30% recovery. You add 1 or 2% recovery from these reservoirs, and you can sustain without massive capital outlays. Now, having said all that, that doesn't mean we don't play with seriousness in other opportunities. And so how are we going to look at that? One, we need to keep doing what we're doing inside the fence and do the best that we can to unlock those resources. Number two, we will leverage the strength of this company to be able to be out there to partner with the likes of Venezuela, with the likes of Libya, with the likes of Iraq, with the likes of Kuwait and others, as they look to be able to open up with partners that they trust and partners that have worked with them for a long, long time. We continue, by the way, to focus on our own exploration capabilities, which we have recently had a full reset of the exploration team, changed out the leadership of that team, and we're starting to see the early stages of success in terms of really securing some exciting acreage in a place like Angola. We secured acreage more acreage in South Africa, acreage in the Gulf. And so that's the other, call it value accretive way of doing it. And then selectively, we will continue to look at the right M&A opportunities with that high bar that I have referenced, but it needs to be able to justify itself to be a value accretive deal. Otherwise, we don't do it, and we have the time to be able to play that out into the coming years. Hopefully that helps, Doug. Sinead?
Indeed. Doug, good to hear from you. You ask a question that can be taken from two different angles, one of which is just the confidence in terms of where we're going to for 2030. So indeed, that confidence comes from two aspects. It's from performance and it's of course from returns. On the performance part, I think Wael has talked to that about driving the company hard, ensuring that every asset delivers on what it can, and actually going even further than that. So you heard about the wave of projects that are coming, so you hear on that aspect of it as well. The other is about effectively return of capital and return on capital. So in terms of that, if I take you through it, in terms of return on capital, we are clearly entering into a phase of capital reallocation. You see it in what we're doing. You see on where we are moving our capital to in terms of allocating it more and more towards the upstream and integrated gas areas versus where it would have been in the past as well. So that's about return on capital. In terms of return of capital, so let's take you through. We've talked about it before. So what's our thinking in that? How do we go about it? We've got 40 to 50% in terms of distributions, which is sacrosanct. You've heard us talk about it more and more, so I don't need to go into that in great depth. But what also we have is we have a very healthy balance sheet. Our balance sheet is sitting at some 20% in terms of gearing. Now remember, we've had a range of 10% to 30%. You always say to me, let's look back over time. So over the 10 years, we've gone between 10% and 30%. So sitting at some 20% is very healthy. And I'm very comfortable with that. And of course, I'm even more comfortable with that because during that time, we've managed to buy back 25% of the shares of this company and done so at a price that averages out at some 20% lower than today's share price as well. So you can see the creation of value there. But of course, one of the things that you ask is, how is that going to be in terms of net debt? If you look at the 3-year period, actually our net debt is roughly the same level as it was before. But what has happened, of course, is that what you see as the gearing has changed, and that gearing has gone up roughly 2%. Where does that 2% come from? Well, actually, interestingly, 3/4 of that 2% is down to those distributions that we just talked about, that our shareholders tell us time and time again that they love and they appreciate the way forward we're doing on that. And actually, the last bit of it, so the remainder, comes from, interestingly, the Netherlands pension reform, if you remember, back a few quarters ago, which is a bit specific to us, but that had an impact in terms of equity as well. So I'm very comfortable with where we are in terms of a balance sheet perspective and where we are from a net debt. And actually, when I look at net debt relative to the cash flow, the CFFO of this company, it is incredibly healthy, not only from our perspective, but also relative to our peers as well. So we're comfortable with the position of where we're at.
Thank you, Sinead. Doug, thank you for the question. Jake, let's take the next question, please.
Thank you. As a reminder, please can we keep questions to one per analyst? Thank you. Our next caller is Henry Tarr from Berenberg.
Hi, and thanks for taking my question. The question probably is a follow-on from that, and I guess then you've talked about securing acreage. are you happy with sort of recent exploration performance? And I guess then, as you think about resource beyond 2035, is more capital going to be allocated towards exploration? And do you have a plan for sort of improving some of the returns there? Thank you.
And we thank you for the question. As part of the reset, what we have done is not just put new leadership in, new targets in, but also made sure that we are really restraining the capital that we're putting into exploration to something that we feel is fit for purpose. So this is not an open bucket. Let's go back to the swashbuckling days of exploration everywhere. We need to be able to prove to ourselves that we can create value out of that. And so you asked me for my report card on exploration. I'd say it's mixed. Really pleased over the last year where we had a good step up in commercial discoveries in basins which are familiar and known to us. Smaller volumes, but highly valuable barrels that allow us to tie back into existing hubs. Less pleased with the fact that we haven't found the bigger plays that allow us to potentially create big new hubs. And so that's the space we need to continue to work on to improve. That first bucket is motoring on well, and I think we have filled the funnel with good opportunities. I think we've really started to fill the funnel for the second bucket with some exciting ones. I mentioned the likes of Angola, which I'm really keen to sort of see where we can get to with that. And that's one that we need to be able to go. But I would characterize our pursuit of resources as being not one that is dogmatic around exploration or M&A or MBD, new business development. We will look at where best to deploy that capital depending on track record, on that risk-adjusted return, where we think we can create value, and we will pivot depending on where that value can be created. Otherwise, we will start to have tunnel vision down one pathway rather than keeping options open and creating value through whatever is in the money at that point in time. Thank you for the question, Henry. Jake, let's go to the next question, please.
Our next caller is Christopher Copeland from Bank of America.
Yeah, thank you. Well, I wanted to ask you about the state of the M&A market. Not what you're about to buy, I get you. You're agnostic on lots of levels. But I guess it'd be interesting to hear from you. You've been in a number of data rooms, what deals that are currently being signed, what they're telling you, whether this is a buyer's or a seller's market, particularly when we speak about the assets that you're looking for, i.e. resources that are yet to be developed, whether it's the Namibian farm down that we've seen from Galp or others. Where do you think the bid ask is currently sitting? And if I may squeeze in another opportunity for Sinead to deny fake news, tell us what's happening with LNG Canada, whether it's FID of phase 2 or whether it's a farm down there. Thank you.
You want to start with that one?
Yeah, no, absolutely. Thanks, Christopher. And indeed, you know what I will always say on anything similar to Argentina. Of course, you see a lot of news coming through. We will look at every opportunity to deploy our capital sensibly and to maximize value. So we have no, sacred cows, holy cows. We've used both expressions, or I've used both expressions throughout. But in terms of LNG Canada, what I would say is we're not divesting from assets that we have high conviction in. So very much in LNG Canada, we're looking at making sure that that performance is delivered. I think what you're seeing is commentary in the press about reallocation of capital and speculation as to whether we would look to get out of anything which is, say, parts or elements of it. The way I think about it is just pure and simple, where are the returns on every part of our asset base, and therefore is there somewhere where I should have my money tied up, and that's what Wael and I spend our time looking at, or is there somewhere else it could go? And that's actually true across the whole of the portfolio. We will look to maximise the value of every dollar we have sitting there. So if it's low returning assets, or if there's a better place to put it, we will do that. And you saw it, for instance, with the Colonial Pipeline. You know, we were able to realise value from our stake in the Colonial Pipeline. It wasn't a strategic control point for us. We were able to actually exit at some, over 9 times EBITDA as well. So it's those sorts of things that we will continue to look to do.
And to Sinead's point there, Chris, that focus on capital reallocation, I would say, is an important now area of my and Sinead's focus in this part of the journey that we're on as a company, because we believe there is over 15% of the capital employed that we have, the $225 billion, that we could actually redeploy into higher return opportunities, which we want to actively be looking at. To the heart of your question, and that of course plays into it, as we redeploy some of that into, for example, M&A opportunities in upstream and beyond, I would say the market is somewhere in the middle at the moment. It used to be at the higher end of the 60 to 70 range, and now we're closer to the lower end of that 60 to 70 range. And it's sort of in that space, so it is not out of what we have seen, call it mid-cycle conditions in the past. I think there's different things at play. I mean, there's one interpretation of the subsurface by different players. There's desperation by some to be able to create investment cases for themselves. And what you have seen us do is to look at all of these, and where we have been able to win is where we have had a real differentiated advantage, like the bolt-ons that we did in 2025. Now, as we look at some of the other opportunities, I'm sure things will continue to evolve, and we'll see how we will compete for those. But the most important thing for me is to keep that broader frame of strategic patience, accretion when we do these deals, and making sure that we can add value to the barrels that we're bringing in, not simply adding resource for the sake of being able to satisfy a KPI in our books. And that's the approach that we will continue to use. It is fair to say that this will take more of our time, of course, as we get that performance muscle much more embedded into the organization. Thank you for that question, Chris. And let's go, Jake, to the next question, please.
Our final caller is Ryan Todd from Piper Sandler.
Great, thanks. Maybe if I could ask one on an asset that you mentioned earlier and has also been in the news, Bonga Southwest. I think reports have suggested that you're targeting a 2027 FID there in Nigeria. Can you talk about what hurdles you need to clear over the next 12 to 18 months to reach FID? And then maybe more broadly, could you talk about the broader resource opportunity in Nigeria and other kind of existing basins within your portfolio like that, and what may or may not have changed to make things more attractive in some of those areas?
Ryan, thank you for that question. Let's start with Nigeria. I was there, I guess, a couple of weeks ago now to meet the president, and was very encouraged by the real drive to be able to support investment in the resource base of Nigeria. Of course, you know what we've done on the onshore, having exited that. That's opened up our opportunities now much more in the offshore. Bonga Southwest is a material resource. And what were the conditions precedent? A key condition precedent was a set of fiscal supports to be able to make this an investable project, which I was very pleased that the president was committed to providing in the coming days as part of a gazetting process that needs to happen, which means we already have now kicked off FEED, and indeed, as you say, looking to develop that into hopefully what is an investable project. So now it really is just follow through on all sides to be able to make this the project we need it to be. It's important to recognize that there is a lot behind those funnels in deepwater Nigeria for us. We have a project called Bozi. We have projects like Nuadoro. These are all projects that now are starting to make their way through the funnel as the investment climate opens up in Nigeria. And we are talking about hundreds of thousands of barrels there. And so we are actively going after those and developing them. Of course, where we continue to have a lot of music is in Brazil and in the Gulf of America, where we have existing resources. Some of the discoveries that I've mentioned are in the Gulf that tie back into our existing asset bases as well. We're excited by areas like Oman, where we have significant access to gas resources in the blocks that we operate. We're building out in Malaysia at the moment, and so on and so forth. So this is a portfolio that continues to create opportunities for us. And we are making sure that what is within our reach, we are maximizing the value from, while at the same time looking at those exploration and M&A opportunities that I referenced earlier. Let me therefore close off and thank you for your questions and for joining the call on behalf of both Sinead and myself. In conclusion, we delivered a solid set of results in 2025. And looking ahead to 2026, we believe we are well positioned with an investment case that remains robust through the cycle as a result of the actions that we have taken and continue to take. Lastly, I'd like to highlight a number of upcoming publications, including our annual report release on the 12th of March, and on the 16th of March we will publish our annual LNG outlook, the LNG strategic spotlight, as well as the response to the 2025 AGM shareholder resolution. Wishing you all a pleasant end of the week. Thank you very much for joining.